The world of investing makes you think of Wall Street guys yelling into phones or charts with a bunch of green and red squiggly lines. You're not alone. A few years ago, I thought investing was just for rich people. I had maybe $100 in my savings account and thought, what's the point? But then I learned something that changed everything. Investing isn't just about being rich, it's about consistently growing your potential wealth over time. Hi, I'm Brian, and in this video, I'm going to walk you through the entire beginner journey, what investing really is, how it works, and how you can start with just as little as $100. Let's break it all down. So, what is investing? To simply put it, investing is putting your money to work so that it grows over time. Instead of letting it sit in your bank account where it's earning basically nothing, you put it into something that has the potential to grow. And that might be a business, a group of companies, or even things like real estate. The goal is really just simple. Over time, your money is going to try to make more money. And no, this isn't gambling, because investing sure has its risks, but it's calculated. Especially when you spread your money across many different things, you leave it alone long enough and it sure is going to grow some accumulation over time. Now, here's the key difference. Saving is lower risk, but your money barely grows. Whereas investing carries more risk, but you have more potential for reward. Now, here's the secret sauce behind investing. It's called compound growth. Now, I want you to imagine you plant a tiny money tree and every year it grows a little. The next year it grows based on what it's earned the year before, and then it grows again and again, basically repeating itself. That's compounding. Your money earns money, and then that money earns more money. I know it sounds a little confusing, so here's an example. Let's say you invest $1,000 and it grows 8% in a year. That's $80 a year. Now, next year, you're earning on the $1,080 instead of just the $1,000 that you had the previous year. The year after that is going to be even more. And as you can see, it's just going to keep snowballing into some serious wealth over time if you do it long enough. That's why people say the best time to start investing was yesterday, and the second best time is today. So what can you invest in? So you've got a few main options, and here's the simple version. Ultimately, you can invest into stocks, and that's basically where you're buying a tiny slice of a company, and if the company grows, your investment grows. The second thing you can buy are bonds, where you're essentially lending money to a company or maybe in the government, and they pay you back in interest. So this is usually a little bit less risky, but it has a kind of slower growth in comparison. Now, the third option are things like ETFs, called exchange traded funds, or another thing called index funds. And these are basically just like bundles of many different stocks. So instead of picking just one company, you're investing in hundreds all at once. So you can kind of think of it like buying a smoothie with a mix of different ingredients like banana, apple, kiwi. And ultimately that's, easier and less risky than picking just one fruit. Now, if you're new, ETFs or index funds are one of the easiest and probably I'd say smartest ways for most people to start. Now, they're low cost, well diversified, and have a solid track record over time. So where do you put your investments? Ultimately, you're going to need an account to hold these investments, and these are the two most common options. Number one is a brokerage account. This is like your investing wallet where essentially you can put your money in, you can buy what you want, and take the money out at any time. And you'll pay taxes on profits, but it's flexible and easy to use. You can feel free to use Webull as an option. That's a popular option that I personally like to use that ultimately has a great brokerage account. You can find that in the description below. Number two is a Roth IRA, which is a separate type of account, and this is a retirement focused account. So basically you can put in after-tax money, let it grow, and then when you're older, you can take it out completely tax-free. So if you're young, this is one of the best places to start. Start with a Roth IRA if you can, and after that, use a brokerage account to keep growing your money. So how much do you actually need to start? So you actually don't need thousands of dollars, and instead you can even start with as little as like $50 a month, and that can go a long way. The most important part, in my opinion, is just starting early and being consistent over time. These days, you can invest in fractional shares, and that means you don't need to buy like a full share or full stock of a company like Apple or Amazon, and you can just invest like $5 or $10 or just any amount of money that you have left around at your own kind of self pace. And this still allows you to get some ownership or a piece of a company. Now, if you can invest like 10 to 20% of your income, that's honestly really amazing and a really solid start. But if all you got is like $20 a month, that's still a great start. Any amount of money set aside in this kind of like account is going to allow you to grow your investment over time. Now, when I first started, I was terrified to lose money, but once I saw my first, $5 gain, $10 gain, $15 gain, I realized that this actually works over time in the long term. The habit, in my opinion, matters more than the amount. So what's a simple beginner strategy, you might ask? Now, this is not financial advice, but if you want a no stress approach, here's a simple plan that works for most people. Number one, as I mentioned, if you're young, you can open something called a Roth IRA or even just a brokerage account. And ultimately, I explained the differences before. You can go back and rewind if you want to hear more about that. If you're interested in opening a Roth IRA or brokerage account, be sure to check out one of our affiliate links in the description below. There are some great partners on the channel. Second, the next thing that you want to do is choose something like a low cost index fund that tracks the overall stock market. So something that tracks like the S&P 500 or the 1,000 biggest stocks in the total stock market. The next thing is to set up automatic monthly deposits. So for example, you can put in like $50 every month and it's going to keep consistently flowing every single month. And lastly, ultimately, leave it alone, because if you're not someone who's like day trading, you don't honestly need to be checking it every single day. As I mentioned, this is about building long-term growth. Now, ultimately, this is going to be called passive investing. It's not flashy, but it works. Now, you don't need to pick the next big stock because you don't need to trade every day like I mentioned, but you just really need to be consistent and give your money time to grow. Now, after setting up your account and selecting your funds, you can monitor and chart your investments using platforms like TradingView. I'm going to go ahead and leave this in the link down in the description below. They allow you to do exactly that. Now, let's talk about the mistakes to avoid, because these are things that are going to trip people up when they start investing. Number one is trying to get rich quick. If someone promises you like fast gains or like, oh, you're going to make this much money, it's probably a scam because good things take time. Subreddits like Wall Street Bets is a perfect example of people YOLOing their life savings, chasing the hype, and not even knowing what they're investing in half the time. And they're possibly losing hundreds, if not thousands of dollars. Now, number two is checking your investments every single day. The market ultimately is going to keep going up and down, and ultimately to go higher, it has to come down. So looking too often might stress you out emotionally. So focus on the long-term picture. I highly encourage a lot of people to zoom out and see the bigger picture. Number three is putting all your money in one place. Like I said, index funds, ETFs are a great solid option to do this because it diversifies for you. And ultimately the life goal here is like to never put all your eggs in one basket, because by spreading your money across different investments, you're going to be safer if something fails because you've got a ton of other investments holding you up. Now, number four is waiting too long to start. Now, time ultimately is your biggest asset. If you start small now, you can always build later, but you can't really do the reverse because once time is up, you've only got limited amount of time for your investment account to grow. So starting earlier is honestly the best thing you can do possibly. Now, number five is ignoring the fees. Now, some investment funds charge high fees, or what they call like kind of expense ratios that quietly eat away at your returns, but always just check the expense ratio. The lower, the better. Anything under like 0.2% is pretty solid. Now, for some final thoughts, investing doesn't always need to be complicated. You don't need to be wealthy. You don't need to be, a financial expert, but ultimately you just need to be, consistent and take the first step. You can ultimately start small, be consistent, just like me, and trust the process. Thanks for watching, and I'll see you guys in the next one.